Welcome back to the Deep Dive. It is Tuesday, February 3rd, 2026. I hope you're having a fantastic week. And honestly, if you've glanced at the financial markets at all today, you know exactly why we're sitting here right now.
It's pretty hard to miss. The screens are flashing a very, very specific shade of yellow.
Gold, the shiny yellow metal, the pet rock of the financial world, as the critics, used to call it. It is absolutely surging. I was looking at the charts just before we started recording, and we are hitting historic highs.
Yeah.
We're bouncing around that $4,900 mark, and we even tapped $5,200 per ounce earlier this morning.
It's a psychological barrier that I think a lot of analysts, even the bulls, they didn't expect us to smash through this early in the year. But here we are.
$5,000 gold.
$5,000 gold. It's a very different world than just a few years ago.
It creates this massive frenzy, doesn't it? I mean, you see those numbers, you see the headlines, and the natural human reaction is just FOMO. You think, I need to be a part of this, I need to own some gold.
Yeah.
But then immediately after that thought, you run into the classic problem, the gold problem, if you will.
The physical reality of the metal. It's stubborn.
Exactly. I mean, gold is great as a store of value in theory. It preserves wealth over centuries. But in practice, physically, it's a nightmare. It is heavy. It's incredibly dense.
It's shockingly heavy if you've never held a real bar.
Right. And then you have to find a place to put it. You can't just leave it on the coffee table. You have to buy a safe, or you have to pay a bank for a safety deposit box.
And then you sit up at night worrying.
You sit up at night worrying about someone breaking in. You have to insure it. And let's be honest, in the digital age in 2026, it feels so clunky. You can't exactly walk into a Starbucks, slap a gold bar on the counter, and ask for a latte.
Not unless you want to hold up the line for an hour while they, assay the metal, weigh it, check the spot price. It just doesn't work as transactional money in the modern world.
No.
It's wealth, but it's frozen wealth.
So then, usually, the traditional finance guys, the guys in the suits, they step in and say, well, don't buy the metal. Just buy an ETF. Buy GLD. Buy IAU. That's been the standard answer for 20 years.
And it was a good answer. For a long time, it was. It solved the storage problem. But in 2026, even the ETFs are starting to feel like, well, archaic technology. They have friction.
What kind of friction?
Time friction, mostly. ETFs only trade during stock market hours.
9:30 to 4, New York time.
Right, Monday through Friday. But here's the thing. Geopolitical crises, the things that actually make gold spike, they don't respect market hours. They happen on Sunday nights. They happen on bank holidays.
That is a great point. If a war breaks out on a Sunday evening, gold might spike 10% before the market even opens on Monday.
Exactly. And if you're in an ETF, you're just stuck on the sidelines watching it happen, totally unable to move.
Wow.
Plus, you had the settlement delays, the T+2 rule. You buy the stock, but you don't technically own it or have the funds settled for 2 days.
2 days.
In a world that moves at the speed of fiber optics, waiting 2 days feels like sending a letter by horseback.
So we have this massive demand for gold, driven by this price surge to $5,000. But the old ways of holding it, physical bars, stock market funds, they're lacking. They're analog solutions in a digital world.
And so, enter the solution.
The buzzword of 2026, tokenized gold.
Real-world assets, RWA, living on the blockchain.
It promises the stability of that $5,000 ounce of gold, combined with the speed and utility of a crypto transaction.
The best of both worlds.
It really is.
It's the convergence of the oldest form of money gold and the newest form of money crypto. It turns a static rock into programmable instant money.
And that brings us to the main event. We aren't just talking about the concept today. We are looking at a heavyweight title fight. The two giants of the industry that have emerged from the pack. In the red corner, we have the regulated fortress, PAXG Gold, or PXG.
The institutional favorite,
Yeah.
the one the bankers like.
And in the blue corner, the liquid powerhouse, Tether Gold, or XAUT.
The trader's favorite, the cowboy's choice, some might say.
This isn't just a tech comparison. As we went through the research, I realized this is a philosophical debate. It's a question about what you, as an investor, value more. Strict government compliance and safety, or speed, flexibility, and a sort of stateless freedom.
That is exactly it. It's New York versus the world. It is permission versus permissionless, in a way.
So we're on a mission today. We are not taking sides. We're the referees.
Right.
We are going to impartially report on this debate based on the massive stack of research, white papers, audit reports, and market data we've pulled.
Yeah, we're just laying out the facts as we found them.
So Whether you are a day trader looking to arbitrage this volatility, a long-term hodler who just wants to preserve wealth, or you're just curious why people are sending gold over the internet, this deep dive is for you.
Let's get into the ring.
Section 1, the tail of the tape. Before we start throwing punches and, contrasting these two, we need to understand what they actually are. Because I think there's a misconception that crypto gold is synthetic.
Right.
That it's just an algorithm tracking the price, or a derivative.
That is the first myth we need to bust. Neither of these are synthetic. Neither of these are paper gold in that derivative sense. Both PXG and XAUT claim a one-to-one backing.
One-to-one, meaning?
Meaning for every single token in circulation, there is one fine troy ounce of physical gold sitting in a vault. If there are 100,000 PXG tokens on the blockchain, there are 100,000 ounces of gold in the vault, period.
And this brings up a term that was all over the documents: allocated versus unallocated. This seems like a boring banking term, but it's actually life or death for your investment, isn't it?
It is the single most important legal distinction in the world of precious metals. In the traditional banking world, most gold accounts are unallocated.
Okay.
And that means you are a general creditor to the bank. You have a claim on gold, like a gym membership gives you a claim to use the gym, but you don't own a specific treadmill.
Oh, I see.
If the gym goes bankrupt, you're just one of many people standing in the parking lot trying to get your membership fee back.
That is a terrifying thought if you have millions in gold.
It has happened. Banks fail.
Yeah.
And when they do, unallocated gold holders often get pennies on the dollar.
So allocated is the solution.
Allocated means you have a specific locker with your name on it, and the stuff inside is yours. In gold terms, allocated means there's a specific bar with a specific serial number that legally belongs to the token holders.
Wow.
Both PXG and XAUT operate on this allocated model. The gold isn't an asset of the company. It is the property of the token holder.
And what kind of gold are we talking about here? We aren't talking about, like, jewelry or random coins in a sack.
No, absolutely not. We're talking about the big leagues, London good delivery bars.
That sounds fancy. What does that actually mean?
It's the global standard for professional bullion markets. These are the bars used by central banks, by the IMF, by major exchanges. They have to meet really strict criteria for purity, weight, and appearance. They weigh approximately 400 troy ounces each.
Let's do the math on that. 400 ounces at $5,000 an ounce.
You are looking at a $2 million brick.
That is a heavy brick, and a very, very expensive one.
It is, and that's why tokenization is so revolutionary. Because obviously, you and I, and most people listening, aren't walking out and buying a $2 million bar.
Not today, no.
It's accessible only to the ultra-wealthy or institutions. But with PXG or XAUT, you can buy $50 worth.
Fractional ownership.
Exactly. This is the magic of the blockchain. It slices the asset up. PAXG is divisible down to 18 decimal places. That's microscopic. You can own a speck of gold dust. XAUT has similar divisibility. In fact, XAUT recently introduced a new unit called the XAUT.
The XAUT?
Yes, it's a way to denominate smaller fractions so you aren't trading 0.00004 tokens, which is hard for people to visualize.
Right, yeah.
A XAUT represents a specific fraction of a troy ounce, making it much easier to use for payments or small investments.
So we have physical backing, we have fractional ownership, we have 247 trading. If news breaks on a Sunday, these markets are open. But here's the kicker that blew my mind when I was reading the notes. It's the one thing that makes these objectively better than ETFs for the long term. Zero storage fees.
That's the killer app.
Yeah.
That is the thing that makes traditional finance people scratch their heads.
I want to make sure the listener gets this. If I buy a physical bar and put it in a vault in Zurich or London, I am paying rent on that space, usually a percentage of value.
Correct. Anywhere from, say, 0.5% to 1% a year, depending on the vault and the insurance. Security isn't free. Guards need to be paid.
And if I buy an ETF like GLD, they charge an expense ratio, usually around 0.4% a year. That just eats into your profit.
Constantly.
Over 10 years, that's 4% of your gold gone.
Correct. It's a slow leak in your boat.
But with PAXG and XAUT, zero.
Zero.
How do they keep the lights on? Are they running a charity?
Far from it. The issuers, Paxos and Tether, they've structured their business models differently. They absorb the storage and insurance costs. They treat it as a loss leader, essentially.
Correct.
They make their revenue on issuance fees, when big institutions mint the tokens, and on redemption fees. And in Paxos's case, they take a tiny slice of on-chain transaction fees. But for the passive holder, The cost of carry is effectively free.
That is a massive compound advantage over a decade. Okay, so that's the common ground. They're both backed by big bars, they're both fractional, and they're both free to store. Now let's meet the fighters in their corners.
Let's do it.
Let's start with corner one, PX Gold or PAXG. Who are they?
PAXG is issued by the Paxos Trust Company. Their home base is right in the heart of the financial beast, New York, USA.
Trust company. That is a specific legal term, isn't it? It sounds more serious than just Paxos Inc.
It's much more serious.
Mm.
A trust company is a fiduciary. They're chartered under banking law. Their brand identity is regulation. They are the regulated choice. Their gold is stored in London, specifically in Brink's vaults, which is as secure as it gets. But the core of their identity is that they play by the rules, specifically the rules of the New York State Department of Financial Services, or NYDFS.
The NYDFS, the people who created the BIT license. They are known as the toughest regulators in crypto.
The very same. If you can make it there, you can make it anywhere, as the song goes. But in regulation terms, it means they are scrutinized to an inch of their lives.
Okay, so they are the suit and tie option. Now, corner two, Tether Gold, XAUT.
XAUT is issued by TG Commodities Limited, which is a subsidiary of Tether. And you know Tether, they issue USDT, the biggest stablecoin in the world.
The 800-pound gorilla of crypto.
Exactly. Now, their home base is a bit more mobile, historically rooted in the British Virgin Islands, but recently they have fully embraced El Salvador. They're licensed under El Salvador's new digital asset issuance law.
El Salvador, the Bitcoin country.
Precisely. They have built a regulatory haven for crypto assets. And Tether's gold. It isn't in London, it's in Switzerland.
The land of neutrality.
Right. So XAUT's identity is the liquid choice, the stateless choice. XAUT is known for ecosystem dominance, flexibility, and being integrated into everything Tether does.
Okay.
It appeals to the person who maybe doesn't trust the U.S. government as much as they trust the Swiss vaults.
So we have New York versus El Salvador, London versus Switzerland, regulation versus liquidity. This sets up the core conflict perfectly.
Really tough.
Section 2, the trust and regulation debate. This seems to be the biggest differentiator.
It is the single most important factor for an investor choosing between these two. Because remember, you don't hold the gold. You hold a digital receipt. You have to trust the guy holding the gold to honor that receipt.
Let's unpack PAXG's argument first. They say regulation is a shield. What does that mean for the listener?
It means oversight. Because Paxos is a trust company regulated by the NYDFS, they're held to a higher standard than a typical tech company. They have capital reserve requirements. They have to follow strict protocols.
Okay.
And interestingly, as of late 2025, there has been talk referenced in our sources of them transitioning to oversight by the OCC.
The Office of the Controller of the Currency.
That's a federal-level regulator. That's the same regulator that watches over Chase and Wells Fargo.
That sounds intense.
It is. It puts them on par with national banks.
Yeah.
But the biggest practical benefit for a user is the concept of being bankruptcy remote.
Bankruptcy remote. I love that term. It sounds like a bunker. Explain it.
It essentially is a legal bunker. It means that the assets, the gold, are legally segregated from the company's funds. Let's say Paxos makes some terrible business decisions. Let's say they get sued into oblivion. Let's say they go bankrupt tomorrow. In a normal company, the creditors would come in and seize everything, including the gold, to pay off the debts.
Right.
But because of this bankruptcy remote status, the creditors of Paxos cannot touch your gold. That gold belongs to the token holders, not the company. It is ring-fenced.
That is incredibly comforting.
It is the gold standard of safety.
And they prove the gold is there, right?
Yes. Monthly attestations, and not just by anyone, by top-tier accounting firms like KPMG. They publish a report every single month saying, here are the tokens in circulation, here's the gold in the vault, and look, the numbers match.
There's a trade-off. There is always a trade-off.
With high regulation comes high surveillance.
Yeah.
PXG has strict KYC, know your customer requirements. If you want to mint or redeem directly with them, they need to know exactly who you are.
Passport, utility bill.
Maybe even a selfie.
And the sources mention something that might spook the crypto purists. Freeze capability.
Yes. Because it's a regulated ERC20 token, the smart contract has a function that allows Paxos to freeze assets in a specific wallet if they're ordered to by law enforcement or a court.
So if the government decides you are a bad actor, your digital gold turns to digital stone.
Exactly. It's censorship compliant.
And they've been in hot water recently, haven't they? I saw a note about a fine in August 2025.
Yes, that's a key piece of context. The NYDFS fined Paxos $26.5 million regarding AML anti-money laundering compliance.
26.5 million? That is not pocket change.
It was a significant slap on the wrist. They were found to have some gaps in how they monitored transactions and vetted some of their partners. Now, you can look at that two ways. You can say, oh no, they messed up, they're risky. Or you could say, this proves the regulation works.
How so?
Because the regulator stepped in, audited them, found a gap, fined them, and forced them to fix it. It shows the system has teeth. It shows someone is actually watching. Paxos remains the clean institutional choice, but they're on a short leash.
Okay, so that's PAXG, high safety, high surveillance. Now let's look at Tether Gold, XAUT. Their argument is different. They pitch Swiss neutrality and independence.
Right. Their gold is in Switzerland. Historically, Switzerland is where you put assets if you want them to be safe from geopolitical turmoil or seizure.
It's the vault of the world.
It really is. And operating out of El Salvador now, that's a strategic move.
It is.
El Salvador has created a very crypto-friendly regulatory framework. It gives Tether a level of independence that a U.S.-based company just doesn't have. They're outside the immediate reach of the NYDFS or the SEC. They're playing a different game.
But the elephant in the room with Tether is always the T word, transparency.
It is. Tether is the giant, and they have massive resources. But historically, they have been criticized for being opaque about their reserves. People have asked for years, is the money really there?
The eternal question.
Exactly. Now, to be fair, in 2025 and 2026, they have improved significantly regarding transparency. They're a massive, profitable entity. But that shadow lingers for some investors.
How do they prove the gold is there?
They do quarterly attestations, typically by BDO Italia.
Quarterly versus monthly for PXG.
Correct. It's less frequent. However, Tether provides a really cool feature on their website. You can look up your wallet address, and the system will show you the specific gold bars allocated to your tokens.
Oh, that's interesting.
Serial numbers, purity, weight.
So you can say, that's my bar.
It is. They argue that it's ultimate transparency. Don't trust us. Look at the bar list.
But the expert in our notes, that's you, needs to highlight the counterparty risk.
You have to. Tether has faced legal battles in New York before. They've settled fines. While XAUT is a separate legal entity, TG Commodities, the brand association carries risk. And there are regulatory headwinds.
The Genius Act.
Yes, this is huge. In the U.S., the Genius Act, which stands for Government Entities Network for Integrated U.S. Stability, and in Europe, MiCA markets in crypto assets regulation. These are laws aiming to clamp down on stablecoins and tokenized assets that aren't fully compliant with local banking rules.
And XAUT faces more scrutiny here.
Definitely. Because they're offshore, because they're less compliant with U.S. banking standards, there is a risk that XAUT could be delisted from major U.S. exchanges, or that European users might be geo-blocked.
So it's a bet.
If you're holding XAUT, you are betting that Tether is too big to fail and that their offshore status protects them. If you hold PXE, you are betting that U.S. regulation protects you.
That is a stark difference. One protects you from the state, the other protects you using the state.
So, perfect summary.
Okay, let's move to Section 3, the mechanics of the fight. We know what they are and who backs them, but how do we actually use them? This comes down to technology.
It does, and this is where the user experience diverges wildly.
PAXG is an Ethereum token, exclusively.
An ERC20 token on Ethereum mainnet. That's it. That's their home.
What are the pros and cons of being Ethereum only?
Well, the pro is deep integration. The entire DeFi decentralized finance world was built on Ethereum. So PXG works seamlessly with ASV Uniswap Compound.
Right.
It's widely accepted on the big US exchanges like Coinbase and Kraken. If you're in the Ethereum ecosystem, PAXG is native. It fits like a glove. You don't need to bridge anything.
The con.
Gas fees.
The bane of our existence.
Even in 2026, Ethereum transactions can be pricey during peak times. We're talking $5, $10, sometimes $20 just to move your gold.
Oh, that's rough.
If the network is congested because of an NFT drop or a meme coin craze, you might pay $50.
And speed.
It's not the fastest chain. You might wait 15 seconds, a minute, maybe more for confirmation. If you're a high-frequency trader, that's an eternity.
Now, XAUT takes a different approach. The sources call it a multi-chain strategy.
Tether has deployed XAUT on Ethereum, yes. They aren't ignoring it, but they're also heavily invested in Tron and Ton, the open network.
Tron and Ton, why does that matter?
Cost and speed. Sending XAUT over the Tron network costs pennies, literally fractions of a cent, and it is near instant.
So if I'm a trader moving money between exchanges, or if I'm using gold for payments, I do not want to pay a $10 gas fee.
No, you want to pay 5 cents.
Yeah.
This is the killer app for XAUT that drives their volume. We see massive daily volume for XAUT, around 432 million daily.
Wow.
Compared to PAXGs, which can be anywhere from 101 million to 520 million, depending on the day. A lot of that XAUT volume is arbitrage and transfers happening on these cheaper chains.
And the sources mentioned it's deeply integrated with USDT, right?
Yes. If you're in the Tether ecosystem, moving from a dollar stablecoin, USDT, to a gold stablecoin, XAUT, is seamless. It's like moving from checking to savings within the same bank app.
The sources also mentioned some specific tools that are shaping the landscape in 2026. Baltex.io came up a lot. What is that?
Baltex.io is fascinating because it solves the fragmentation problem. Let's say you have PXG on Ethereum, but you want the speed of XAUT on Tron. In the past, that was a headache to bridge.
A nightmare. You'd have to sell to USD, transfer, buyback, tackleable events everywhere.
Exactly. Baltex aggregators allow you to swap PAXG on Ethereum to XAUT on Tron instantly.
And without KYC.
That is the claim. It enables macro arbitrage. Traders can spot a price difference between the two tokens. Maybe PXG is trading at 5,000 and XAUT is at 5,010, and swap instantly to profit. It keeps the prices aligned globally.
It creates a global fluid gold market. Another tool mentioned was Flash Shift.
Similar concept. It's a non-custodial swap service. It shows that the infrastructure around these tokens is maturing. You aren't locked into one ecosystem anymore. You can hop between the regulated fortress and the liquid powerhouse, depending on what you need at that moment.
And then there's Plasma, not the blood component.
No. This is Tether's payment layer. It allows XAUT to be used for payments almost as easily as sending a text message.
This connects to that pseudo unit you mentioned earlier.
Exactly. Imagine being on a messaging app. Telegram is the big one for TON, and sending 5 XAUT to pay for a coffee. That is the vision. Paying a vendor in gold instantly, using your phone without waiting for block confirmations or paying high fees.
It's wild to think about. Paying for coffee with gold dust over a text message network.
It is the future the cypherpunks dreamed of. Digital cash, backed by hard assets. It essentially demonetizes fiat currency for daily transactions.
So we have the tech, we have the speed. Now let's talk about the physical reality. Section 4, redemption and fees. Because at the end of the day, this is supposed to be gold. Can I actually get the gold?
This is where the rubber meets the road.
Yeah.
And for most people, the answer is theoretically yes, practically no.
Let's talk about the big bar rule.
Both companies generally require you to hold a full London good delivery bar to redeem directly from them.
And we said that's 400 ounces.
Roughly 430 ounces usually, to be safe, at $5,000 an ounce. You do the math.
That is over $2 million.
Right. So unless you have $2 million sitting in crypto gold, you are not calling up Paxos or Tether to ask for a Brinks truck to come to your driveway.
So for 99.9% of our listeners, redemption really just means selling the token for cash on an exchange.
Exactly. You redeem for USDT or USD. You don't get a bar in the mail. You get digits in your bank account.
However, PAXG has an edge here for the little guy, right? I saw this in the notes.
They do. They have a strategic partnership with a company called Alpha Bullion. Through that partner, retail investors can redeem much smaller amounts. The sources say as little as 1 gram.
1 gram. That's accessible. That's a few $100.
It is. Now, here's the catch. You will pay a premium. You have to pay for the minting of that small bar because they have to take the big bar and melt it down or swap it. And the shipping and the insurance. It is not cheap.
But the option exists.
It matters. It matters a lot for the preppers. If the apocalypse comes, the internet is flickering, and you want your metal in your hand, PXG has a clearer path for the average person to get physical delivery.
Whereas XAUT's redemption is strictly Swiss delivery of full bars.
Highly institutional. You fly to Zurich, you pick up your bars, you hire a security team. It is not for the retail user. It is for the sovereign wealth fund or the hedge fund.
Let's talk fees. We mentioned zero storage fees. What about the cost to get in and out?
This is where they differ slightly. XAUT charges a flat fee when you mint or redeem directly with Tether. It's about 0.25% or 25 basis points.
Okay, so on a $10,000 transaction, that's $25.
Correct. It's reasonable.
And PAXG?
PXG is tiered. For institutions, it can be very low, around 0.02%. But for small amounts, it can be higher. However, PAXG has a unique feature, an on-chain transaction fee.
Wait, on top of the gas fee?
Yes. Paxos actually charges a tiny fee, around 0.02%, encoded into the token transfer itself. Every time you move PAXG from wallet A to wallet B, a tiny sliver goes back to Paxos.
XAUT doesn't have that?
No. With XAUT, you only pay the blockchain gas fee.
So for high-frequency trading, XAUT wins on cost. No transaction fee from Tether and cheap gas on Tron.
Precisely. That's why the traders love it. If you're moving money 10 times a day, those 0.02% fees add up. If you're just holding, it doesn't matter.
Let's move to Section 5, Market Performance and Investment Strategies. We're in February 2026. Gold is booming. How are these tokens actually performing against each other?
Well, XAUT has won the size war.
Really?
Yes. For a long time, PAXG was the leader. But in 2026, XAUT's market cap is hovering between $2.3 and $2.6 billion in assets under management.
Wow.
PAXG is trailing slightly, between 1.3 and 2.0 billion.
Why the flip? PAXG used to be the leader a few years ago.
Liquidity and utility. The multi-chain strategy of Tether has paid off. Being able to move gold on Tron and TON attracted the arbitrage bots and the global traders. XAUT often sees higher daily volume because of this. Liquidity begets liquidity.
And price action. They both track gold, obviously.
They track the spot price, yes. But because of liquidity differences on different exchanges, you sometimes see slight premiums or discounts. XAUT might trade at $5,000 to $5 on one exchange, while PXG is at $4,995 on another.
And that's where the Baltex.io traders make their money.
Exactly. Macro arbitrage. They buy the cheap one, sell the expensive one, and pocket the difference. It's risk-free profit if you're fast enough.
Now, here is where it gets really interesting for me. Yield. Gold is a pet rock. It sits there. It doesn't pay dividends. It doesn't pay interest. Warren Buffett used to hate it for that reason.
Right.
But tokenized gold.
It can be put to work. This is the holy grail of DeFi.
Yeah.
You can take your PXXG, which represents gold, and deposit it into a protocol like XAUT.
And use it as collateral.
Yes. You deposit gold, and you borrow stablecoins against it. Let's say you hold 10 ounces of gold. You don't want to sell it because you think it's going higher, but you need cash to buy a car. You deposit the PXG, borrow USDT, buy the car. You still own the gold. If gold goes to 10,000, you capture that upside.
Or you lend your gold to someone else who wants to short it, and you earn interest.
Exactly. You can earn maybe 2%, 3%, sometimes 4% APY on your gold.
So I can hold gold, keep my exposure to the $5,000 price, but also earn interest on it. That changes the math of holding gold entirely.
It does. It turns a sterile asset into a productive asset. But, and this is a big but, you are introducing smart contract risk.
There's no free lunch.
Never. If XAUT gets hacked, if the code fails, your gold token is gone. Physical gold buried in your garden doesn't have smart contract risk.
It just has neighbor with a shovel risk.
Exactly. You're trading one risk for another.
The sources also mention Tether's own arbitrage strategy.
Yes. Tether is an active player. They aren't just the issuer. They buy physical gold and mint XAUT to exploit price gaps themselves. They did a transaction recently, bought 3,102 XAUT for $13.7 million.
Wow.
They are active participants in their own market, managing the supply and demand. They are the whale in the pool.
Let's touch on privacy versus safety one more time before we wrap up the comparison.
It's the eternal struggle. PXG offers high transparency. They say, we monitor every transaction. For an institution, that is safety. It means you aren't holding dirty money. It means you aren't accidentally accepting gold from a sanctioned entity.
For a privacy advocate,
it is surveillance. It is Big Brother. XAUT, while still centralized Tether, can freeze assets too. Offers more privacy options simply by being on chains like TON and having access to non-KYC exchanges. If you want to stay off the radar, XAUT is generally the path people take.
So we've broken down the fighters, we've looked at the tape, the trust, the tech, the fees, and the market. It is time for the conclusion. The verdict.
Let's summarize.
If I'm a listener and I want the institutional standard, I want to sleep at night knowing the NYDFS is watching. I want monthly audits, I want bankruptcy protection, and I am okay with Ethereum fees and KYC.
Then you choose PAXG. It's the gold standard for compliance. It is the closest thing to a digital gold ETF, but with better hours and ownership rights. It's for the long-term, safety-first investor who values the U.S. legal system.
And if I'm a trader, I want speed. I want low fees. I want to move money across chains. I want liquidity. And I'm willing to accept the offshore risk of Tether to get that utility.
Then you choose XAUT. It's the liquid choice. It's the currency of the crypto ecosystem. It is for the person who wants to use gold, not just look at it.
But there is a third option, isn't there? The neither option.
We have to acknowledge the physical purists. We would be remiss if we didn't. If the internet goes down, if the power grid fails, you cannot access your PXG or XAUT.
You can't verify the blockchain if the blockchain is offline.
Exactly. Physical gold has zero counterparty risk. Tokens rely on Paxos or Tether not failing, the internet working, and the vaults not being emptied by a heist.
It is amazing to me that we can email gold now. That is essentially what we're doing.
It is. But in 2026, diversification isn't just about assets. It's about custody models.
Yeah.
A robust portfolio might have some physical coins buried in the backyard for the apocalypse, some PAXG for the safe digital allocation that's easy to liquidate, and some XAUT for trading and yield.
You don't have to pick just one. Diversify your diversification.
Exactly. Don't put all your gold in one basket, and don't put all your baskets on one blockchain.
Before we go, I have one final thought I want to throw at you, a provocative question to leave the listeners with.
Let's hear it.
We've talked about gold on the blockchain, but we know Tether is buying up massive royalty rights. They are investing in physical mines. We're seeing these stablecoin issuers becoming massive players in the physical commodity market.
They're vertically integrating. They're becoming the market.
Right. So are we moving toward a future where stablecoin issuers like Tether or Paxos have more influence over the actual price of gold than central banks?
That is the multi-trillion-dollar question. When the digital wrapper starts controlling the physical asset, everything changes. If Tether decides to buy 500 tons of gold next week to back a surge in XAUT demand, the market moves. The Fed might not be the biggest player in the room anymore.
Something to mull over. That is it for this deep dive into the gold rush of 2026. Thanks for listening.
Always a pleasure. Do your own research.
See you next time.